Hi, Brett Hetherington from Hetherington Associates. With the 30th of June 2014 approaching quickly, I thought it might be a good idea to look at some tax planning strategies for small business. The topics I thought I'd cover in this video today will include the deferral of income, bringing forward or accelerating expenses. We'll also look at stock takes. We can look at asset purchases, and lastly, I just want to touch briefly on superannuation. Okay, let's look at deferral of income. I think the first point that we need to discuss and look at with regards to deferral of income is that, are you accounting for your tax on an accruals basis or a cash basis? Generally, small businesses with turnovers of less than $2 million a year will actually be accounting to the tax office for tax purposes on a cash basis. So the whole idea of deferral of income around those cash businesses would be sending your invoices later in June so you don't actually receive your money until July. For businesses with a turnover of more than $2 million a year, they account to the tax office on an accruals basis. When they raise an invoice, that is when they declare income to the tax office for tax purposes. So a deferral of income mechanism for accrual businesses would be to not issue any invoices until after the 30th of June. Okay, now let's look at expenses and things that you can do for your business before the 30th of June. If you're accounting on a cash basis for taxation purposes, what you should be looking at is those type of expenses that you can incur before the 30th of June. For example, you might need repairs and maintenance done to plant and equipment, motor vehicles. You're allowed to prepay expenses up to 12 months in advance. So you could look at prepaying 12 months worth of advertising, paying a yearly subscription before the 30th of June. You could potentially look at prepaying interest on a loan if the facilities are there to be able to do so. What you're doing when you're actually accounting on a cash basis is you're paying for your expenses before the 30th of June, and that's how you get your tax deduction. I hesitate on recommending buying stock, because if stock's counted on hand at the 30th of June, buying any stock or material before the 30th of June may not assist taxation. And also, if you're actually buying assets, especially more than $6,500, they need to be depreciated, so they're not really going to give you an immediate upfront tax deduction either. For accrual businesses, it's a little bit more difficult. They're not really able to prepay expenses because of the prepayment rules for prepayments made more than $1,000. But you'd be looking for an accrual business to make sure that all the creditors have been recognised by the 30th of June. Okay, our third point today is a stock take. So those businesses are required to do a stock take at the 30th of June. Generally, those businesses that are actually undertaking the resale of items, so retail businesses, manufacturing businesses, for example, that buy in a lot of stock and have it on hand before the 30th of June. What you're looking at to assist from a tax planning point of view when you're doing your stock take is you've effectively got three methods to undertake your stock take. You've got the cost method, which is generally what most people use. The replacement method, you can look at the replacement cost of the item if that's less than the cost price. And I think probably the third and the most important item about stock takes is look at your obsolete stock. You may or you may not be aware that your obsolete stock you could actually value at a lesser value. If you don't believe that you'd be able to undertake any sale with that type of stock and that, then you really should be writing it off at nil value. Generally, what you're looking to do for your stock take is you're trying to find those items and that you can value less than cost to help minimise your closing stock, which ultimately will minimise your profit for tax purposes. Okay, asset purchases. As covered in our budget video that we did a few weeks back, the current Liberal government were not successful in able to overturn the current $6,500 automatic write-off for asset purchases to bring it back to $1,000 as it was previously a few years ago. So I think that we should consider the fact that seeing that they were unsuccessful in passing the legislation, that $6,500 rule should still be in place at the moment. Might be an idea for some small businesses that are looking to buy some equipment. Being less than $6,500, we should be looking at getting an immediate deduction for that before the 30th of June. Okay, the last topic today is superannuation. Superannuation has been used as a tax minimisation strategy for both individuals and businesses for a long period of time now. The majority of people in Australia would know that the government has certain contribution caps or limits with regards to superannuation, so I strongly advise that you talk to an advisor in relation to whether superannuation is going to form part of your tax minimisation strategy before the 30th of June. But currently, for self-employed people and business people, there's an opportunity of making up up to $25,000 a year into super as a tax deduction. And for those people that are fortunate enough, some of the older clients and so forth, and that have the potential of making $35,000. But the large majority of clients, and it's a $25,000 contribution cap. But I strongly suggest that you actually do discuss this with your financial advisor and that before you look at superannuation as being your tax minimisation strategy. So in conclusion, with regards to our tax planning video today, the topics that we talked about are the deferral of income, bringing forward prepaying expenses. We looked at stock take, we looked at the $6,500 automatic write-off rule, and we looked at superannuation. If you've got any further questions, don't hesitate to contact us, give us a call or an email. You have a great day. Thank you very much for your time.